Success in multifamily investing seems to be bulletproof recently. But you have to put in the time and effort first. Lane Kawaoka has done just that and is now investing in rental properties across the country while living in Hawaii. Find out how he has hired the team to help manage properties without him ever having to see them. Lane tells Joe why he doesn't believe there's tax benefits to investing in your retirement accounts. Tune in to find out why.
Hello, Lane. Welcome to the show.
Thanks for having me.
Thank you. You're coming all the way from Hawaii, right?
That's correct. Aloha, everybody.
And did you grow up there, or how did you land there?
I grew up here, but was up in Seattle for a dozen years, investing on the U.S. mainland. But, when you got some cash flow coming in, you live where you want.
I like that. So give us, our listeners, some background about yourself.
Yeah, so I grew up in a household where we were taught to be very frugal with our money and go to school, be good little boys and girls, buy a house to live, all that jazz, right? I went to engineering school, became an engineer, and started working and started to buy that house to live in, right? Like they kind of brainwash everybody to do. I was working on the road all the time and was never home to enjoy that house. So I just decided to rent it out. And the mortgage was $1,600. The rents were $2,200 a month. And to a young 20-something-year-old kid, that was a lot of beer money back then. But more importantly, that was I got a taste of cash flow, and I was like, shoot, if I just do this a bunch more times, I'll be able to quit the day job I didn't like.
Now, how long ago was that first property you bought?
That was back in 2009. Bought a couple more in Seattle, Washington, and then I realized sophisticated investors, they kind of invest more for cash flow as opposed to capital appreciation. I mean, appreciation is great, but it's kind of up and down, right? As we've seen before, 2008, certainly now, through a pandemic, it can be a little rough, but I think prices has kind of rebound, right? It's up and down. But I think I kind of realized early on that my end game was to quit my day job. To do that, I needed monthly cash flow. So I needed the property to cash flow on a monthly basis. So I started to go and buy properties out of state in Birmingham, Atlanta, and Indianapolis after that.
Now, when you started purchasing them, was that through a group, or do you buy directly for yourself?
So a lot of investors who are super green out there can go through like what's called like a turnkey provider. So these guys, they're usually small time flippers, rehabbers. They'll grab a kind of a beat up house, put a bunch of work into it, and they'll pretty much like renew the major systems like the plumbing, the roof, the HVAC, new paint, new kitchen, and sometimes they even put a tenant in there for you. So it sort of is truly turnkey, as the name implies, or training wheels for the new investor. Now, I mean, I did that once, maybe twice, but then I started to get my own broker team and property management. The property manager is probably the most important person to help you vet a remote rental. And then in 2015, I had 11 of those things.
Nice. Do most of those turnkey programs manage the properties also for the investors?
Yeah, sometimes they have it in-house. Sometimes there's like a sister company. I would always recommend my folks to go out and find a third party, a completely separate company, because there's an inherent conflict of interest there, right?
So let's go into the areas, I guess we'll start with acquiring the real estate. How did you target a specific area?
Yeah. So first thing is numbers, right? So people can kind of learn about this or kind of embody this right now. Like we look for 1% rent to value ratio properties or greater. So you take the monthly rent divided by the purchase price, and we're looking for that 1% or higher. And why are we doing this? Well, we're looking for our properties to cash flow on a monthly basis. So when you're above that 1% rent to value ratio, you're fairly confident it can cash flow. Of course, at that point, you're going to need to go and get an analyzer and kind of check your numbers, make sure your insurance, your taxes all make sense. If people want, they can download my free analyzer on my website, simplepassivecashflow.com/analyzer. Go over there and download it for free. But let's go with this 1% rule for now, right? So a lot of places that won't work are your primary markets like Seattle, all of California, Hawaii, Boston, New York. Ain't gonna work. Those places, you'll be lucky to find a 0.5% rent to value ratio place that's not in the ghetto. So that kind of takes us to places like Birmingham, Atlanta, Indianapolis, Kansas City, Memphis, Little Rock, Jacksonville, like these second tier cities that aren't as sexy, but the numbers work. And then, of course, we're looking for places where the population is increasing, good economic growth and more red states. And not the same thing politically, but when we are the landlords, we want the laws on our side, as opposed to taking 12 months to evict somebody who doesn't pay and squats on your property in California.
Now, in these secondary markets, is there any, are you gearing, I guess, to make that 1% rule more on the affordable side, I assume, when it comes to the average house value?
Yeah, I mean, typically does like turn out to be more affordable, right? So a lot of the places we're trying to get for folks is like $100,000 or less. That runs for, $900,000 or more. I think it's just a matter of fact, like you're just not in a prime market where prices are ridiculous. And, most people live in good housing that are around low six figures.
Now, I know most people in this market, they're obviously, whether they're getting started or they've been investing for a while, that 1% rule is getting harder and harder to find as the values have been going up. And maybe people need to look to areas outside of where they reside. Kind of what is your opinion on being a remote landlord?
Yeah, do it, man. It's not that hard. I mean, I've been doing it since 2012 is when I went out of state. I mean, I think that's what makes it, it's a little daunting, right? And it sounds a little crazy. You're buying a property that you probably don't visit. It ain't worth it to go visit, but you got to rely on your team, right? You get a property inspector, you get a property that the lender is going to do their due diligence for the title, et cetera. You're going to get a broker, right? Hopefully you get a good broker that's just not trying to sell you another deal, just like any other broker out there. And most importantly, you want that property manager to kind of vet the rents and vet the property. So between those four team members, 4 vendors, I mean, you should be able to buy a property. I mean, after all, you're buying a commodity, right?
So now what markets are you focused in?
So today we buy apartments. We like certain states, Arizona, Texas, Alabama, Georgia, Carolinas, and Florida. I think you take those 5, 6 states, you're going to kick the butt of the rest of the United States any day.
Now, is there anything, what are some underlying data that you look at when underwriting these certain geographic areas or the houses in particular? Yeah,
so the 2 leading indicators for a good market, or what we call an emerging market, is population growth. That's probably indicative of a good economy, right? Because you can't really measure job growth. It's a lot harder. But I believe that job growth kind of goes hand in hand with population growth. Population growth is a readily available statistic out there. I mean, you just Google, population growth Birmingham, and Google makes a nice graph for you pretty simply. But what I would also key in on is rent growth per year. A lot of good data houses, they keep this statistic, and that ultimately, I feel like, really measures the demand for housing, right? How much are the rents going up every year? Normally, they'll go up by 2 to 3%. Anything higher in a certain market is kind of indicative of a hotter, more demand market. A little less, you just don't really see less than 1% these days.
So now that you've narrowed in the certain markets that you want to invest in, obviously you might need some capital to make these acquisitions. Do you guys go out and raise capital? You use your own capital?
Yeah, when I first started, I had a good paying day job, right? Most of my clients today are doctors, lawyers, engineers. If you don't got money, you're bad with your money. You got credit card debt. Sorry, man, this ain't for you. This is real estate investing. You need to invest. You need money to invest, bro. Today, we go out and acquire apartments because deals are harder to find, and we need to kind of get above the mom and pop investor level, right? The mom and pops are buying properties under $1 million or $2 million. We also stay below the institutional players that are just investing pension funds and retirement funds for a low yield. These guys are hovering around the $15 to $30 million range. So we stay in the sweet spot between a few $1 million and $20 million, which is a pretty big gap, is where we are. We're considered private equity. So we go in and we buy 100 to 300 unit apartment complexes that are stabilized, 90% occupied in the beginning. And there is some opportunity for some light value add to bump the rents up. That is our business plan. And we kind of go in and we syndicate a deal amongst passive investors. And each venture is kind of a special purpose vehicle. And, each kind of separated liability wise, business plan wise, and dollars wise.
So what steps have you taken along the way to be able to raise that type of equity for each deal?
Just build up a track record, right? I'm going to tell you a lame thing. There's nothing practical here. I mean, you just got to like keep doing it, right? I mean, I've been investing since 2009. In 2015, I had 11 rentals, and I realized rental properties isn't really scalable, especially for accredited investors, right? Most people make it six figures or even more, like way more, multiple six figures at their day jobs. Your highest and best use is not buying rental properties. I mean, it was what got me from zero to $500,000 net worth. And I think everybody, if your net worth is under $500,000, you need to go buy some rentals to get some experience. And to getting the experience to go grow your passive investor network, right? Your network is your net worth. If you don't have any experience, you don't have any rentals, you don't add value to any other pure passive investor. So you don't know who to invest with at that point. But yeah, I mean, just keep doing deals and doing bigger deals. We started to do a lot of Class C properties under 60 to 80 units. You know, they were kind of difficult to work with, but that's where we cut our teeth on these larger deals. And these larger deals are quite frankly easier to run because they are more stabilized, they are more robust, bigger budgets, bigger cash reserves, and the property management on these commercial assets are a lot more sophisticated than your residential property managers.
When you're raising equity from investors, are they typically utilizing retirement accounts, cash, or the combination?
Combination. More on the topic of retirement funds, I typically don't recommend them at all. I mean, I don't know anybody who will put money into retirement funds if they knew, number one, you want to pay your taxes today, right? You want to pay, your taxes are likely lower today than in the future because I call me optimistic, but I'm going to make more money in the future, be in higher tax bracket. Number two, I mean, look where this government and all these government entitlement programs are going. Taxes are going to be going up in the future. Therefore, pay it now. Pay it now while the tax brackets are lower. Number three, most of us can get financially free doing this in 10 years or less. I ain't going to wait till I'm 50, 60 years old to take out my retirement funds. Heck no, I want it out now. And lastly, I just kind of discovered this recently with the new cost segregation and bonus depreciation laws, you get passive activity losses. When you're investing through a supposedly tax-free retirement account, which is sort of great, but what you're missing out on is like you don't get the passive activity losses to be able to pull levers on your taxes today. People want to check out my tax return. They can go to simplepassivecashflow.com/tax. Check out my tax return. I think I paid 4% last year and 0% in 2020. That's what the wealthy do, right? We invest in deals. We get our money working. That's what the government wants, and the government rewards us by these tax benefits.
So you're saying basically, are you saying that to the extent that you are consistently reinvesting into real estate and utilizing the tax benefits, that there is no need to use retirement accounts where you can't access cash until you're older?
Exactly. I mean, and the added benefit of you getting these tax benefits today, so you have the levers to pull. Because I have a lot of high net worth or high paid doctors. They might make $600,000. Well, if they employ real estate professional status, we try and drive that down to the $330,000 AGI range, right? I mean, there is really no reason why anyone would need to go to a foreign country to run away from taxes. You can live in America and drive down your taxes with your passive activity losses, right? And that's the power of real estate.
I think there's definitely areas of tax code through different industries that have some certain type of benefits. And real estate's definitely one of the most powerful ones.
Yeah. I would like to invest in crypto or internet businesses, but I know I have to make almost double than I would real estate to end up with the same money in my pocket at the end of the tax year, right?
Yeah, I agree. So so most of the equity that you raise is coming from just, I guess, higher net worth for professional people?
Yeah, people between $1 and $20 million net worth, they want to diversify their money. Usually the minimum's around $50,000, $100,000. So that allows them to diversify over, dozens of projects, right? And have a diversified pool. And, they're the passive LP partner. So no liability, little to no liability. They're not getting any of the debt in their name. It goes in my name and my other general partners. We sign on the debt, and now they're diversified over different partners, different geographic areas, different business plans, and different asset classes too. Multifamily, office, self-storage, mobile home parks. I mean, they can piece together their portfolio as they wish.
What are some of the most important underwriting decisions for a limited partner when they're underwriting the deal, but also the general partner or the operator of the deal?
Yeah, so for passive LP partners, I'll be frank, most passive investors don't have a clue how to underwrite deals. A lot of times they ain't even on the pitch deck. And this is what is kind of dangerous about syndication deals. Any yo-yo can put together a syndication deck if they find the right Upwork person on the internet and puts together a pretty PDF, right? Especially in this day and age of the internet, it's really, everybody can make a website. So it's really hard for a passive investor to determine who's legit out there. One of the ways is knowing to me, the top three things to look for on underwriting is, what is the reverse and cap rate? Are they assuming that the market's going to be crappier in the future? What number are they using for that reverse and cap rate? Another one is, what are they using for the assumed rent increases per year? As I mentioned previously, if you're seeing something that's like 3% or higher every year, that might be wishful thinking, right? And that may be an indicator of the overall conservativeness of the underwriting. Unfortunately, a lot of times these things aren't even on the pitch deck for the passive investor to figure out. And therefore, I think that the best way, and ultimately the long-term solution for passive investors, is to build their network with other pure passive investors and invest off people they know as good organic relationships, have invested with the past and gotten a good experience. And this is where the term, relying on your operator, right? Knowing who you trust. But then personally, I always see good operators. They call it sponsor creep, right? They keep increasing their fees, increasing their splits, and becomes a worse deal, even though they have a good track record, right? Good for them, right? Any business operator knows that as you get a good track record and you get a good system going, you increase your pricing, right? You have people lining up around the block to invest with you or buy your product. Same thing, no different than this. So how do you do that? Well, you keep them honest. You make sure you kind of look at what are their key things on their spreadsheet that they're using for assumptions to make sure that you're just not getting loosey-goosey with their underwriting over time. And I think that a lot of that is on my website. I usually just write articles about this. If you want to learn more, they can go to simplepassivecashflow.com/syndication, read up on that.
So for those that maybe have no relationships, right? And obviously they hear about maybe the benefits of real estate syndication. I mean, from a network or online meetings, where's the next places they could go if they have those relationships where they could kind of get that word of mouth from it currently?
Yeah, I don't know, man. You're walking on landmines out there. It's 2021. Every Joe Blow has a podcast these days, right? Every Joe Blow has a book that they pay someone, a ghostwriter, 10 grand to do. There's a way of engineering celebrity that is very they've been doing this for several decades now on the internet. Again, you have to build your network with other pure passive investors. And if you don't have rentals, this is why I recommend people getting rentals, because it helps you get into the network of other pure passive investors. We're all rich people. That adds no value to another rich person, right? But when you come in with some experience, some war stories of your own rentals, and you come with some expertise to add value and help out other people, that is where you kind of get in the inner circle, and you can be like, all right, who are you investing with? Or who should I stay away from? Maybe more importantly.
All right. So once we have the capital raised for the deal, obviously the next step is probably after closing is going to be management of the deal. What does your team look like, and what are some of the most key important things to bringing that management together?
Yeah. So my role is mostly like sourcing and operating the deal, but the day-to-day management is done by third-party property managers. These are where your big manpower is. Like, we have staff at the property. We like these larger properties over 100 units because we can justify in-house person to be sitting at the leasing office at all time. It gives that property that in-house or that the live person experience, right? Somebody's always there to answer the phones, or if somebody wants to do a showing, somebody's always there. But I think we really need to get over 100 units to justify getting that person in the golf cart running around knocking out little work orders from time to time. We want them to do the plumbing repairs in-house, right? Then calling that third-party plumber. People who own rental properties know that you get gouged by just some little plumbing repair, right? But whereas we fix it in-house under salary. A lot of times we'll try and get our guys HVAC certified so they can knock out a little HVAC repair. Again, not using third-party costs. That might be triple, quadruple what it really costs us in for our guy to do it before his first smoke break of the day.
In your experience in hiring property management and or on-staff management, what are some of the biggest, key lessons that you have taken away?
We've had to fire property managers because they just aren't hitting KPIs. And that's how we run things, KPIs. And that's how you manage anybody. And that's what I learned in corporate America, right? What are the things that you measure them on? Most people they want to know what the score is. Good teams want to know what the score is so they can hit it. If you don't have those metrics, now it's hard for your property manager or your employee to kind of follow your lead. Those key metrics are like occupancy. Really basic, right? How much are they putting heads in beds? Are they collecting the rents, which is collections, right? Normally we hover around 97% collections because we're in this workforce housing sector, $700 to $1,400 rent. People don't have too much savings, right? It's class B and C workforce housing. 97% is normally what we collect. So if we know it's dipping down into the mid 90s, now us, the manager, we need to figure out what the problem is. What can we help out on? Is there some system or is there something that's systemically going wrong that we need to put our heads together? Another KPI we may measure is showings, right? Maybe that may be an indicator that marketing, we're just not marketing the damn thing, right? We're not doing our paid advertising, right? Showings that actually close, that sign a lease, right? That could be that's a clear indicator that our leasing agent sucks, right? And maybe we need to incentivize that person for that metric.
So when aggregating all these KPIs, I'm taking it that both sides, you and the management, have some kind of software in place, right? And what are some of the best software programs out there that you've seen, or what has worked for you guys?
I mean, I know AppFolio is a popular one, but I don't know. I mean, that's their job, right? That's their business. I stay out of it. Whatever they're using, we'll use.
So you guys just basically make out your own list of what KPIs you want, give it to the manager.
I mean, they're all the same.
Yep.
I mean, it's, they built that software in the 90s. It's nothing breathtaking these days. It does what it does, and they're all sort of the same.
Now, when managing your properties from a remote distance, what are some of the things that people can put in place to make that run smoother?
Yeah, so it's a little bit different. Like when I'm talking apartments, like our setup is a little bit more robust. This is why we like it. Our commercial property managers are very grown up and they're very sophisticated, right? Which is why we can run up to the KPIs. Now, where the problems arise is for the little mom and pop single family home investors with their residential property managers. First of all, we don't know if the residential property manager is legit or not, right? Most times they're not. They just run around and try and collect checks from individual houses. And this is what makes a mom and pause investor's job even harder, right? Because typically mom and pop investors are very unsophisticated. And like there's no KPIs for those residential contracts. And in fact, a lot of times the owner, the investor, and the property manager are not aligned in anything. I mean, think about it like this: if the property goes vacant, now the property manager is incentivized to get lease it up, where they get like 50% of the rents at least, and sometimes they even get 100% of the first month's rent. So it kind of is incentivize the property manager in the residential world to make that property go dark, which is obviously not what the owner wants. But it is what it is. Like people are like, oh, you can change. No, that's not how it is. That's not how this world works, right? This residential property world works. There's a lot of things that are messed up in the residential world that I don't like. Mainly that it's more of an emotional based pricing. It's on the comparable sale approach, where in the commercial world, it's more on the net operating income, the numbers. But I think that's, at least you know what the problem is, right? As a residential mom and pop investor, and you have a good relationship with your property manager, you talk through problems, you give them enough leash to solve the problems themselves, but you keep them accountable, right? If something needs to get repaired, well, you ask them what the game plan is, right? What are we going to do? All right, you're going to go get that fixed. It's going to be about $600. Well, if it's over $500, could you get me a couple of comparables or bids? So I know you're just not being the lazy guy and getting the most expensive, easiest price from your buddy, to do it. Those are the things you need to be doing as a mom and pop investor. And then inevitably, when they don't do it 6 days later, you ask, well, what was the hang up? What was the failure? What can I do to make sure you don't do that again? Implicitly saying, how can I make sure you don't mess this up again? Right.
It's very important as the owner, I guess, to be always on top of the property manager and be consistently managing the manager, correct?
Right. But it's a very difficult fine line. Most people are either they don't do anything and they just let their property manager run it into the ground, and they don't care because they're an unsophisticated investor that owns it cash. They don't care. They're cash flowing, which is a very big mistake. Or they just micromanage the heck out of a good property manager, and the property manager fires a client because they're just a pain to work with, right? It's very difficult to kind of understand where to be.
What are some other strategies that people can employ to get involved in bigger deals? I think so many people, I guess, get, I don't want to say trapped, but, busy, we'll call it, managing those single families because it's actually so much work involved, and they're kind of missing out on the bigger picture, or maybe the larger size deals. Yeah,
I think it's just awareness, right? I kind of had my head down for several years until 2015, when I just by chance started to hear whispers of syndicated deals, right? I thought they were like Ponzi schemes. Yeah. But then I started to, I'm an introvert and I kind of stick to myself if left to my own devices. And that was what I did from 2009 to 2015. It wasn't until 2015 was when I started to get out of my shell and started to network with other pure passive accredited high net worth investors. Unfortunately, a lot of these people that you're trying to find aren't on, the free meetups. They're not the local RIAs. They're not on the free forums, internet forums, because a lot of those places are just filled with a bunch of broke guys, right? You're trying to find accredited high net worth investors. They are not on that stuff, right? Most of the other platforms just have a bunch of broke guys trying to wholesale flip properties. That's definitely not what we're doing as buy and hold investors, and certainly not syndication buy and hold investors. I mean, once you start to hear about it, you'll become more aware of it. And I think it just takes time to develop your network once you start to realize what you're targeting, who you're trying to find.
So when it comes to simple cash, passivecashflow.com and the organization, what are you guys doing?
So my mission is to kind of help out hardworking professionals, trying to dispel all these bad, financial advice. Invest in 401ks, retirement accounts, goodness gracious, if you want to do it for 50 years and investing in garbage assets, go ahead. And what frustrates me are all these Wall Street products, as I mentioned, they keep the hardworking middle class stuck, right? And I was a good little boy at one time. I thought that I should just I'm buying a house to live in. If you live in a primary market, I would say go and invest your money and make more money instead. Now, buying a house is good for people who are irresponsible with their money, who can't seem to save it. So their house is a forced savings account. For those people, which I would say most people out there, maybe not the people listening right now, go and buy your house. But if you go and take that huge down payment and go buy 5 to 10 rentals instead, your money's obviously going to grow much more, right? And so there's a paradigm shift between, what is Dave Ramsey, Susie Orman advice out there, and this other advice that kind of we help people with simplepassivecashflow.com. This other advice for people who are pretty decent with their money and make a pretty good salary. There's a different way of doing it. It's kind of a double-edged sword.
So are most of the members all geared towards real estate investing?
That's how I got my start. I'm starting to kind of branch out in some different sectors like website investing, some life settlements. But I honestly think that real estate investing, especially when you invest in stabilized properties that cash flow with value add, I think that's the best risk-adjusted return that you can get out there. At the end of the day, it's backed by a hard asset. Just look what happened in the pandemic. Over 4,500 rental units that I own, 97% of the rents got collected normally, and maybe it went down to the mid-90s, but we're still making money if we can stay above the 60% range. What other asset class out there did you have those types of buffers in terms of profitability? And it's a hard asset at the end of the day. It's not like some dog coin or whatever.
Dogecoin, yeah. That's
douche coin or whatever. These
memes across the internet. It's pretty crazy. I don't know.
It's hilarious, huh? Yeah, people don't know what we're talking about. You can go to the Reddit forums and look at Doge or Dogecoin, or Douchecoin is what I call it.
You can look at GameStop. You can look at all the things that are kind of making the news and see what's going on. But probably long term, it's not going to be the best bet there. But real estate has provided safe returns, hard asset over many, many years.
Yeah, you're not gonna get like rich overnight, but it's a get rich surely thing. And if I can double my money every 5 years, that's a pretty damn good return for me. That's something that's a hard, real asset that cash flows in good times and bad times. And the fact that it gives me the tax benefits to screw around and pay little to no taxes, that's another benefit. And it's boring. I mean, and maybe here's another twist to it, another way of looking at investments overall. I like to go into things that I have an unfair advantage in, right? That not everybody can get into. Any dude could get an app and buy a Bitcoin or crypto, right? A lot of people can buy a rental property that's, $100,000 with a $20,000 down payment. But not everybody can buy an apartment where you need to know who to work with. You need to have $50,000, $100,000, right? That level of competition just thins the herd, right? And for people who maybe went to Ivy League colleges or in some, pretty high profile circles, it's all about thinning the herd, right? Getting in opportunities or situations or investments where not the average man can compete with you.
How well has building out your own network or own group, moved you along in doing all these deals?
It's a game changer. I mean, I get pick of the litter, right?
Yeah, I think it's very important for people to realize that at the end of the day, a lot of this all comes down to the network, correct?
Yeah, your network is your net worth. But I would say that if you're under $500,000 net worth, don't waste your time talking to people. Just go out and make some money, right? You got to get unbroke, right? And I think that's where a mistake where a lot of these like gurus kind of say, well, network is your net worth. Because I see all these kids like networking crazy. And I'm like, dude, go make some money. Go get it. I'm not a big fan of jobs, but go get a job, right? Save the money like how I did. Like it took me like 7 years to get to 11 rentals, just meticulously saving my money, 50, 100 grand every year. I bought rentals with that money, right? It took me a while to get myself up to at least at bat, right? And when you're at bat, and I would call that somewhere around $500,000 net worth, then you network. That's the order of operation. Then you network with the right people, right? But people, I think, do things opposite, right? Either they are like that young networker that just networks the heck out of things and doesn't do anything, right? Or maybe I was kind of on this trajectory, right? I just kept to myself, do my own thing. And then I'm that old dude that with 40, 50 rentals, just going crazy out of my mind with all these unscalable investments, right? Like those are two mistakes. Don't be like that.
And outside of your own network, has there been, masterminds or other groups that have worked well for you, and why?
Yeah, so that was like my key pivot back in 2015 to get around those high net worth folks. Some of these masterminds are pretty expensive. They can be upwards of 25 grand a year. Most of us people listening right now probably thinking that's probably crazy, but numbers don't lie. I mean, if it leads to another investment or a partnership that equates to triple that, quadruple that, I mean, it's a no-brainer, right? I think the key is you're kind of building up that social currency of that Rolodex of people as you navigate these areas. And part of this is just, you see what's happening in this world, right? There's so much data, right? There's so many people, right? It's that you're paying for curating this stuff. Time and money are sort of, they're interchangeable, right? By paying for a mastermind, you're trading money for time, because you're curating the people. And it's hard today because everybody can dress fancy. Anybody can talk a good game, but who actually is legit? Well, when you actually charge people at the door 25 grand to get in, it kind of thins the herd. Right? You still have to do your due diligence on people, right? Because some bad actor can kind of slip through the cracks. But if people are making pretty good money from their operating businesses, then they can usually pay to get into the door. And this is exactly why like these free meetup groups, these free RIAs, these free online forums are just the wrong places to go, because you pay for what you get.
I like that. So if you pay nothing, you're typically not getting the best.
Yeah, I mean, as you hear some people saying, well, like what I do is I try and find the most expensive networking thing to go into, even though it may or may not be an indicator of what the product is, but it typically is. And because it's time there's somewhere down the road when your net worth hits to be $500,000 to a few million, time becomes more valuable than money.
I agree. And that kind of leads us into, our final question. And that is, what is the biggest thing you've implemented that has increased your net worth?
It was a network. Yeah, that's for sure. I mean, again, I was buying these rental properties. I thought I was really cool. I thought I was going to get to financial freedom with these rentals. But then I realized what a pain in the butt these single family home rentals were and how unscalable what they were. And if it weren't for getting around other high net worth accredited investors who also did it, what I did at one time, kind of saying, yeah, I did what you did. And I realized it wasn't scalable too. And to have that kind of mind mesh with multiple people, I would have never realized that there was something better, right? I think we all get stuck in this world where we think we self-confirm our biases, right? We think that what we're doing is right. I think that's why high achievers always feel like they always want to be learning, or at least have that open mindset. Yes, they want to be very strong-willed with their convictions of where they're going, but part of them is always listening, right? There could be something better. There always is something better that you haven't found. I mean, at one time I thought single family home turnkey rentals was the way to financial freedom. Obviously, I've changed my mind. And right now, I think, investing in dozens of syndication deals is the way to go. Diversifying your portfolio over different asset classes, different partners across the nation. But I don't know. I mean, there could be something better, right?
You don't know what happens in 5 years, right? So the world could pivot and something else could be up, right?
Right. I don't know if I invest heavily in multifamily apartments. I think that, I like the thesis, right? The country's population is growing. They're not making any more land. This is the lower middle class is what needs this housing greater these days. And ultimately, we're the ones to provide it for them, right? The government's not going to do it. But that could change, right? I mean, you never know what's going to happen. Normally, our investment thesis is in tough times that Class A folks, people in the luxury new build stuff will go on hard times and come to our apartments, the more value B class stuff. But that never happened in the pandemic, right? In the pandemic, the white collar workers, the higher end guys, they were unscathed. They just had to buy their Grubhub and stay in their ivory castles, right? They never came down, but we're fine, right? You just never know what's going to happen, right? And I think that's why I have a strong conviction with multifamily apartments as my primary investment, but I do invest maybe with 20% of my portfolio into different asset classes for diversification, but also being able to pivot should something happen in the future.
I appreciate that. So the network is most important. Always be learning and have the ability to be open-minded to pivot in different directions if you see an opportunity. Right.
But then believe in yourself, because only person who actually cares about you is you.
Well, look, Lane, I appreciate coming out today. For all the listeners, what is the best way to reach them, for you to them to reach you?
So if you want to learn about some alternative investing for wealthy folks, go to Simple Passive Cash Flow Podcasts. SimplePassiveCashflow.com has a lot of different guides out there. And my email address is lane@simplepassivecashflow.com. Thanks for having me.
I appreciate it. Thank you. Hey, everyone. Thanks for watching my latest interview. If you like what you saw, please click the subscribe button below to become a member of the Joe Robert community. Be sure to hit the bell to turn on all notifications so you always know when I post a new video. Tell me what you thought about the content in the comments below. I always read them and would love to answer any of your questions.